Hello everyone and welcome to Coaltrans Connect. Coaltrans Connect is a webinar series sharing detailed analysis about the changing global coal market. Today's session will be looking at the Indian coal market, and the 3 sessions after that will be looking at the European coal market, the Indonesian coal market, and a gas outlook for the coal industry. Many of you will know me. My name is Julia Harty, and you've probably met me at a Coaltrans event over the last couple of years. My role as conference producer involves doing the research, writing the agendas, and working with our wonderful speakers. I'd now like to introduce our speakers. Next slide, please. First of all, I'd like to introduce Pankaj Satija, who works as the Chief of Regulatory Affairs for Tata Steel. He has more than 25 years experience in strategic planning, project management, mine planning, mining operations, training, production, and maintenance. VK Arora is the Chief Mentor of Karamchand Thapar and Bros Coal Sales. He has worked with the company for 50 years and was previously serving as president. Anurag Sehgal is the Principal Analyst with Noble Resources, focusing on carbon steel raw materials and India macro. He has written several papers on the coal sector and co-edited a book on coal in India. Alistair Ramsey is Head of Research at Fast Markets Research Division, where he has been for 8 years. Before that, he was Principal Consultant at CRU for 8 years. Hello to those of you who have just joined us. So as you can see, today's session is all about India in lockdown and the impact on the domestic coal market. Just to start things off, I'm going to do a quick poll just to see some of your views on how the coronavirus is impacting the Indian coal market. So please take a second to just vote. So share your opinion with us. So the question is, how long before COVID-19 cases peak in India and lockdown is lifted entirely? The question again, how long before COVID-19 cases peak in India and lockdown is lifted entirely? Okay, so the most popular answer is 6 to 9 weeks with 35%. The second most popular answer is 4 to 6 weeks at 30%, and the third most popular answer is 9 to 12 weeks at 15%. Just so that the speakers have an idea of who is in the audience, we'd like you to let us know which area of the coal chain you work in. So which of the below best describes your job function? So the options are end user, coal producer, trader or broker, research analyst, consultant, transport, shipping, logistics, legal, insurance and finance, or other. As you can see, the most popular answer with 30% is trader or broker. In second place, it's research analyst or consultant with 25%, and in third place, it's coal producer with 21%. Okay, so thank you very much for that. Good to see who's with us today. So as you can see on this slide, today's session is all about the Indian coal market. Coming up after that, we have a session on the European coal market, the Indonesian coal market, and then a gas outlook. Next slide, please. Okay, so I'd like to thank our sponsor for today. EcoCarbon and Crew Overseas Coal Trading Company for sponsoring today's webinar. Next slide, please. So today's session is titled India in Lockdown, Impact on the Domestic Coal Market. This presentation is broken into 5 parts, a macro overview of the impact of COVID-19 in India, the power sector, imports, steel, and then coking coal. At the end, we will, within a few days of the webinar, we will send you a link to the recording and also include the slides. At the end of this webinar, we will be doing a Q&A. You can either ask a question by using the raise hand function or by typing a question into the Q&A. We will be prioritizing any questions that are asked via raise hand. I'd now like to hand over to Anurag for part 1.
Thank you, Julia. Hello, audience. In the first part of my presentation, I'll be covering the COVID-19 situation in India and the response of the government and where do we stand in terms of the world right now. So right at the outset, I'd have to mention that the lockdown in India has been pretty stringent. Oxford COVID stringency tracker shows that India imposed one of the most severe lockdowns, giving it a score of 97.35 among the various countries that it ranked. It ranks this based on several parameters, which includes weighted parameters on the completeness of economic shutdown, level of fiscal support, and the period of shutdown. So altogether, give us these ranks. Because of this stringent lockdown, the India infrastructure 8 core industries overall growth rate index for the month of March tanked to minus 6.5% YOY. And this is in the background of 7 days of lockdown in March. April, it's expected to go even lower, but I mean, how low is something is anybody's guess at the moment, I guess, because of the complete shutdown in April. Just on this point, I just looked at the PMI numbers, services PMI for India today, and the number was abysmal at 5.4. Yeah, you heard it right. It was 5.4 industry services PMI, which is really bad. So where do we stand in terms of the COVID outbreak? The cases, we have already completed more than 40 days of lockdown, one of the longest periods across the world. It started on 23rd of March. The doubling rate has slowed down from 4 days initially to 12 days now. However, the total cases have spiked. So yesterday, I think around 4,000 cases was the largest single day spike in India. This comes in the background of Italy, Spain, and Germany and other European countries starting to loosen their lockdown and restarting their economic activity, which India is also following up in gradual staggered manner, but challenges remain. So the recent outlook for the government was to eventually, in a staggered fashion, start lifting lockdown, because of which they focused on district-wide spread and notified districts on 3 broad color codes, which indicates the intensity of spread in those districts. As you can see, most of the western and northern districts and states of the country are in yellow or orange or red, which means the intensity of lockdown and the intensity of COVID spread is much higher in those areas as opposed to the central and eastern part of the country. And they are starting to continue, they are retaining the lockdown in stringency of lockdown in those areas and loosening the eastern part of the country. However, the demand recovery, even after the lockdown and the staggered kind of exit from the lockdown, is going to be a challenge because of 3 key reasons. One is a liquidity issue. MSMEs, which are the backbone of Indian manufacturing and exports, contributing 30% of GDP, 40% employment, and 50% exports, have severe cash crunch and liquidity issues. The second issue is the labor force. Most of the manufacturing and economic activity zones are in the urbanized western and northern part of the country and southern part of the country, of course. And the migrants now, after 40 days of lockdown, are starting to feel stressed and migrating back to the hinterland, the rural areas which are typically in the eastern part of the country. So the economic start would be subdued till these economic migrants return to the industrial clusters and restart the activity. So that is one thing. And third part, which is more universal and not specific to India, is the fear psychosis. A lot of companies have announced pay cuts for at least foreseeable future, no hikes this year. And the uncertainty on jobs and the fear psychosis is kind of will reduce consumer spending going forward as well. Now, where is the government and the RBI, the monetary and fiscal institutions, in all of this? So RBI has been proactive in lending, in not lending, but at least ensuring liquidity in the system, reducing repo rate, reverse repo rate, operating targeted long-term repo operations, $22 billion liquidity at that point. But the problem with all of that is that the financial system, the banks, and the shadow banking system in India has been grappling with a plethora of bad loans for a very long time. And that has made them somewhat of a risk averse. So what we see over here in these graphs is that the net borrowings out of RBI, lendings out of RBI, the negative number means that the RBI is retaining that liquidity, versus positive number means the banks are not parking that liquidity with RBI and moving it forward. So we see this number has been steadily growing. That means the banks are still parking their cash, surplus cash with RBI. It was 7.3 trillion at the point of this presentation. When I prepared this presentation, it is 8.3 trillion now. So, at the same time, this is on the monetary policy side, but the fiscal side, the government of India has announced one of the lowest fiscal support packages of around 0.8 to 1% of GDP, which is limited by its precarious finances. Government finances are a challenge. Although oil price top, which is 65% lower for the basket of crude in India, has reduced the dollar demand, keeping the currency stable and reducing the current account deficit, probably providing some more elbow room. So where does all of this leave us? The worst is probably behind in terms of lockdown, but not in terms of COVID, because we are easing some economic activity in green zones. But the same can't be said for the pickup in economic activity. So we expect, given the precarious set of government finances, lesser inclination to more fiscal bailout as opposed to more focused approach on the monetary policy side from RBI. Although because of the flush nature of funds right now, imminent rate cut is probably ruled out. CPI supports that, 6% rate cut. Eventually, we may see more easing going forward. But the demand recovery is, again, heavily contingent on the control of COVID-19 spread. Urban areas likely to trickle back to economic activity, but not the exact normal pre-COVID. It's going to be a new normal post-COVID. So in our view, and in my view, I think the Q2 calendar year seems to be a wash. Q2, Q3 hopefully should be better, but again, dependent on global recovery. With this, I come to the end of my presentation and I'll pass it on to Mr. Arora for his slide. Just bear with me for a minute while I transfer the screen.
Thank you. Can you hear me? Yes, Anurag, can you hear me?
Yes, we can hear you very well.
Okay, thank you. So friends, we are meeting at a very critical stage where the status of coal, as I see it now, is something which we had never seen before. In the last 1 minute, please. Why is it not working? Okay, can you please take the control and do the changing? Next slide. Okay. Okay, so this present status of coal, as I see now, has never been seen before in the last 50 years. We are graduating from an era of shortages to an era of plenty. Power plants today are flush with coal, 25 million tons at power plants. The first slide, please. Next slide. Yeah, so their power plants today are flush with coal, 25 million tons at the power plant, good for 22 days, and nearly 75 million tons at the pithead, at the mines. So 100 million tons of stock of coal today is something which is never heard or seen before. So that's going to make a material difference to the availability of coal for the coming year. So last year, if we see on the table, 602 million tons was produced by Coal India. I think this year they got a target of 710 million ton, but they should do 650 to 700 depending on the demand. Singareni will remain the same. Now the captive blocks here. So captive blocks are something, you know, which 56 million tons. Now I have a strong feeling that had there been no corona, they would have been able to produce something like 100 million tons. But corona has definitely slowed down the whole situation, but they will come back. So this year, they'll probably produce 65 to 70 million tons, and others would remain the same. Now, so this makes it to something like 730 or 740 million tons. What happens to the imports? So that's something which is very important for us. 235 million tons we did in the last year. Now, Coal India, see, we met the director of marketing last week, and he said that the government has mandated them that they should replace at least 100 million tons of import by the indigenous coal. So how are they going to do it? They are going to replace almost 25 million tons in the power sector and 75 million tons in the non-power, non-regulated sector. See, the sector which does not have to, you know, like fertilizer, cement and all these things, this is non-regulated sector. So these sector will be, nearly 75 million tons will be replaced. So out of 235 million tons, if 100 million tons is replaced by Coal India, so the imports are going to be at a level of about 135 million tons, out of which coking coal will remain at the same level, 45 million tons, and the coastal power plants would probably continue to prefer using the coastal coal because of the cost economics. So they will be 80 to 90 million tons will be something like, that is what they are going to be, importing. So total of 135 million tons in place of 235. That's my feeling about it. Next, please. Now, what is going to be the game changer? So unless handicapped by the low demand, Coal India will try to reach, they have a target of 1,000 million tons by 2024, but they should be able to reach about 850 to 950 million tons, depending on the kind of demand they see there. They are capable of doing that. Now, what is going to be a game changer would be the production coming from the captive as well as the commercial blocks. Captive blocks are at the moment, as I said, they should have produced 100 million tons, not this year, but at least next year they should be able to do 100 or a little bit more than that. Commercial blocks is something that is going to be a game changer. They are going to be advertised. There are 200 commercial blocks which are there in the pipeline, out of which 50 will definitely be bid auction during the course of the current year. Now, a lot of, facilities have been given. FDI, FDI has been permitted 100%. So the companies like BHP, Peabody, Glencore are all looking at seriously. So once, the blocks are completed, 50 blocks by the end of this year, then I have a feeling that something like 500 million tons will start coming over a period of 4 to 5 years. So that's the kind of timeline which the government is also thinking. Why I said it's a game changer? Because it is for the first time a company, a private player is going to give some sort of a competition to Coal India, which has been living in their own comfort zone. So it will be a good thing for the country. And I think that it will also be able to meet a substantial part of the upcoming demand. So if Coal India produces 1,000 million ton, the imports, the blocks are going to produce 500 million ton, nearly 100 to 200 million ton coming from captive blocks. So what is this going to change? It will probably have an impact on the imports, adjusted accordingly. Coastal plants and coking coal users will continue to import, but rest will probably try to get more into the indigenous coal. Next, please. Next. Anurag, next, please. Anurag, are you there? Next.
Just, yeah, I'm changing it, yeah.
Now, unfortunate situation as of now with the power sector is that 85% of the power companies are today financially sick and losing very heavily. No, that's a very sad news, because entire coal and entire, this is going to produce power. And if power plants are not healthy, there's going to be a serious problem. So what is the reason? The main reason is that the PLF, the power plant load factor, which used to be something like, as you see in this table, 77.5, it came down to 60 at the end of the last year. It has now running at 56. And my feeling is that it is going to come down at 250. If it is 50 is going to be the PLF during the course of the current year, it's definitely not healthy for the power plants, and they will probably continue to lose. So next please. So as I said, 85% of the power plants are today sick. So they have to, if there is any assistance to be given, that assistance should be given to the discoms. The power plants are the one which are producing the power. It is passed on to the distributing company known as the discoms. Now they are supplying to the discom, but which discoms are once again financially sick, and they have to be bailed out every 3 years or 4 years. The state government or the central government has to come to their rescue, try to help them out with some money. Why? Their cumulative losses are something like 1.5 lakh crores. Say enormous amount of loss. Every time the government tries to pull them up, but frankly, nothing much happens. They still remain at the same level. Why are they why are they continuing to lose money? They are not allowed to charge the market price, though that's something which is a political decision, not their decision, but politics demands that the power has to be sold to the farming sector, the domestic sector at subsidized prices for which nobody gives the money. Inefficient they are because transmission losses are 25% against the private players of 10%. There's a lot of power which is stolen. And then if they don't have money, they do not pay the power producers. So power plants cannot run at full capacity. So the entire system has to change. Coal India will be able to supply coal. Power plants and discoms, they have to set their house in order. If only they do that, the rest of the things will fall in line. So this is all I have to say about the subject. Thank you very much. Back to you, Anurag.
Okay, we're going to do a quick poll now. So before we start part 3, we are just going to do a poll to ask you, how do you think Indian demand for thermal coal imports in 2020 will vary against 2019? So please let us know, how will Indian demand for thermal coal imports in 2020 vary against 2019? Okay, so roughly half of you have voted. Okay, so we're now going to share the results. So as you can see, the most popular answer was that you think it will decline by 30 million tonnes to 139 million tonnes. 33% of you think it will decline by 20 million tonnes to 149 million tonnes. And 19% of you think it will decline by 10 million tonnes to 159 million tonnes. And with that, I would like to hand over to Anurag. So Anurag, you need to unmute yourself and turn on your video. Okay, so while we just wait for Anurag to come back, we're going to do a quick poll. Oh, okay. So we are going to do a quick poll looking at demand for Coal India. So please let us know, how much do you think that Coal India can produce against its guidance of 710 million tonnes this year? Okay, so the options are more than 710 million tonnes, 650 to 710 million tonnes, 610 to 650 million tonnes, 610 million tonnes, or less than 610 million tonnes. Okay, I'm now going to share the results. So the most popular answer with 36% is 610 to 650 million tonnes. The second most popular answer is 650 to 710 million tonnes. And the third most popular answer with 20% is less than 610 million tonnes. And with that, I'm going to hand over to Anurag.
Thank you, Julia. You can hear me, right?
Yes, we can hear you.
Okay. Cool. So thank you for being patient, audience. There's some technical glitches happening over here. So in this section of my presentation, I'm going to be focusing entirely on the power sector and coal update. Since I've given the context of the background of the COVID and macro situation right now. And this talks about the power sector and coal update now. So moving on to the next slide. Yeah. So as you saw in the first section of my presentation, the urban areas, basically top 5 states which have been impacted by the worst by COVID spread, are the states contributing around 40% of the GDP. They account for 64% of all cases. The number may be higher now because this data is Citibank data of 23rd April, and it would be the proportion distribution would probably still be the same, but the urban areas are more impacted in general. On the other hand, if you look at the mining areas, which I have highlighted over here, which is on the eastern side of the country, the spread at that point, and still the spread is not that high in those areas, which basically means is there is a demand. These northern and western and southern regions are basically demand areas. Those are supply areas in terms of coal. and these are power demand centers. So the demand drop has been substantial as opposed to a decline in supply side, because there has been lesser impact of COVID in those areas in the eastern side of the country. So how much we have lost in April? About 34 trillion watt hours, TWH, worth of power generation due to lockdown, which implies, and to put this number in context, around total growth last year of power generation was around 12 trillion units. 12 billion units. This is only utility I'm talking about. There's captives would be in addition to that. So this is the impact of lockdown on the power demand. In general, as Mr. Arora mentioned, power sector has been crippled with problems downstream, mainly on the DISCOM side, and that reform is a crying need for the sector itself. In general, the growth of power generation last year, because of the limited number of limited consumption, and the growth in general was around 1%, which is not entirely thermal. This is overall power generation. The alternate sources like renewables, hydro, etc. grew year on year, whereas the thermal power generation itself declined by 1.75%. So the need for reforms is very important on the DISCOM side, as Mr. Arora highlighted. So what does it mean for, what does it look like going forward for this year? So our base case for this year, again, predicated on the recovery scenarios, resumption of economic activity and demand recovery, etc., is around 6% decline on electricity generation. Mind you, this is entire electricity generation, segregation between renewables versus conventional and thermal, coal, etc. would be a different. Coal itself has been lower year on year last year. It will probably be more low this year. The decline will be steeper this year. What does it mean for coal imports in that case? Just on this slide, there are two other alternate scenarios. One is the best case, which itself is a 2% decline, and the worst case out of that is around 9% decline. So we are not looking at any growth this year at all. I mean, it's choosing between the worst case versus the best case, which are all negative. What does it mean for coal? So high domestic coal availability, as Mr. Arora mentioned, is across the entire supply chain. CIL, in the backdrop of high, in this year has set itself a target of around 710 million tons. The inventory still remain high at the mines, around 75 million tons, at the coal plants around 50 million tons, and the production for April is around 44 million tons from CIL, which is seasonal low, but not. It's adjusted for economic activity as well, the demand slump as well, and the inventory side. So what CIL has done now is increased initiatives to reduce the inventory, which means it has removed 10% markup on auction reserve price. It has increased the trigger values for long-term supply to consumers. And in the same backdrop, the government is also trying to reduce the imports. However, that particular part, to my mind, is not very simple, because there are various moving parts to that. One is, as Mr. Arora mentioned, the coastal power plants, which is around 50% of the total installed capacity, which are spec to certain quality of boilers. The boilers are spec to a certain quality of coal, which they need for blending. The second problem is switching from boilers from one to the other is a long drawn process. They have been speaking about retrofitting, etc., but the cost, the financial implications, the pass-throughs, how that regulatory process works is a little unclear at the moment. At the same time, if you want to switch the coastal power plants to domestic supply, there's going to be a problem with railways, because railways has an inverted cost structure, wherein the freight is charged substantially higher than passenger transportation. So that needs to be adjusted as well. And that makes landed cost of coal at the power plants domestically competitive with imports. So I think that's something which need to be kept in mind. The third part is the grade slippage. CIL has persistent quality issues on grade slippage, which imposes a cost penalty on the consumption of energy at power plants, which needs to be addressed. There have been measures to address it, but it hasn't been completely addressed thus far. Blending, which is the Ministry of Environment and Forest notification about allowing coal with lower ash content only for short haul, not allowing high ash content coal for long haul, which is again a spanner in the works. So because Indian coal is typically a high ash coal. So I think well-meant measures to reduce forex output for India, forex outgoes for India on imports, but this is not a short-term scenario with government kind of putting its foot down. It's more supply impacted in terms of the coal demand as opposed to government policy directed. Now, what does it mean for coal imports? As I spoke about various scenarios, power generation depending upon worst, best, and base cases of power generation, and translating that on all of these parameters of various import locations versus how much generation happens at various parts in the country, what kind of quality of plants are there, etc., etc. And also breaking down on the source of generation, renewable versus thermal and coal. We can look at our base case is around 21 million tons decline year on year, which is possibly something which most people spoke about in the polls as well, I guess. And the best case would probably still be 15% decline, whereas the worst case at a negative 9% growth in power generation would probably imply lower coal imports by around 30 million ton. So, and how soon does it start? I mean, I've mentioned that in the first part of the presentation as well. It depends upon how soon we implement the staggered exit from lockdown, how soon after that the demand improves, and how soon the cases peak, the COVID cases peak. And also, it's also a lot of export dependent production in the manufacturing sector in India as well. So that means how the West, the European countries and the major trade partners of India recover, that also will determine the speed of recovery on Indian power demand as well. And with that, I come to an end of my presentation and I pass it over to Alistair.
Thanks so much, Anurag. Ladies and gentlemen, I'm just going to go slightly off scope of the thermal coal market and back into the steel market and the demand for met coal. I suppose one of the things I'd say is that I think it's probably quite obvious to everyone listening that the impact of COVID-19 on Indian steel has been severe. It's been severe everywhere we look, really. But for the analysts who are listening, all 25% of you or whatever, it's quite tricky to judge the impact of COVID against the impact of other negative factors on the international steel market. By way of context, I would just say that the steel industry has been slowing down now for a couple of years. So the World Steel Association recently published their latest perspectives on 2018, and they saw that demand was growing by just over 4%. We estimate last year there was a slowdown to 3.5%, and actually in the first quarter of this year, that slowdown has become far more dramatic. And indeed in March, steel consumption fell in China on a year-on-year basis by 1%, and it fell by well over 10% in the rest of the world, including India. Now, India, as you may know, has been one of the star performers of the steel industry for some time. It reached over 100 million tons of steel consumption in 2019. But as this chart shows, in March in particular, there was a dramatic, seriously acute erosion in demand. The Ministry of Steel calculates that there was a year-on-year decline of something approaching 30% in apparent finished steel consumption, just an unheard of development. So if we were just to look at the next 8 or so months of the year, 9 months even, we would find that if India were to continue to decline by 30% per year every month, we'd be looking at a steel consumption decline of nearly 25% in 2020. That's 25 million tons, or about 10 million tons of coking coal demand. The interesting thing about the steel consumption decline is that it hasn't really been replicated upstream. So far, at least, the demand for steel from hot metal, that's the red line you see in this chart, has been relatively stable right through March. If the steel industry has reacted to a steel demand erosion since March, as Anurag said, hideous decline in India in particular, and a PMI reading of something like 5 points, unheard of data. It's been very clearly impacting the non-iron making sectors, the non-coking coal using sectors. It's crude steel that's come down, but via the EAFs, the scrap-based mini mills, and the induction furnaces. So in terms of coking coal, in kind of the black shaded area, the demand's been somewhat stable. If we can move to the next slide. And that stability of coking coal demand thus far in India has been a boon for the Australian seaborne suppliers. The Indian destination exports from Australia are represented by the purple bars below. That's the biggest contribution, the biggest destination, the most popular destination for Australian coking coal. And in recent months, you see the volumes have actually been going up to India, just as they've been going down everywhere else. So there's a real concern in the coking coal market that if India is going to have some horrendous Q2, a wash, as Anurag said, and maybe only a little bit of improvement through the second half of the year, what on earth's going to happen to coking coal demand? Because India is the driver at the moment. Not even the Chinese are buying more coking coal. And with the Mongolian trade reappearing into China, the volume of demand into China from the seaborne market, the non-Mongolian trade, must disappear. So moving on to the next slide, if you can, Anurag. What does the industry do about this? Well, perhaps the steel industry is somewhat slow in reacting to demand erosion, and we've got stock building. And as we've heard earlier, the coal industry is somewhat slow because in India, at least, the stocks are rising. But when it comes to metallurgical coal, to coking coal, some of the biggest players in the market seem to be heavily cutting back on production. So this is the year-on-year changes in coking coal output in Q1. Now, if the coking coal industry is to continue refraining from increasing production, then it's highly possible that the prices of coking coal that we have today, which are somewhat low relative to recent years at about $110 for the premium hard coking coals, may not fall back into the double-digit figures per dollars per ton that we saw prior to 2016. If they can keep supply down, it's possible that the coking coal price will not fall the way demand for coking coal appears to be falling in the short term. And those are my remarks for today. Thanks so much.
Thank you very much, Alistair. Before we begin the fifth part of the presentation, we're going to do a quick poll just to see how your views vary from our speaker. So the question that we would like to ask is, how will Indian demand for met coal in 2020 vary against 2019? The possible answers are decrease by more than 7 million tonnes, decrease by about 5 million tonnes, stay flat, increase by 5 million tonnes, or increase by more than 7 million tonnes. Okay, so as you can see, the most popular answer with 41% was decrease by more than 7 million tonnes. Option number 2, decrease by about 5 million tonnes, also had 41%, and then stay flat had 15%. Okay, so with that, I will hand over to Pankaj. Thank you very much.
Yeah, already Alistair has mentioned about the steel making. In India, the steel making is largely insulated from the world. We have been knowing that India is a country of great potential. Many believe that the potential has not turned into performance. And some analysts believe that it was the inflection point which India was waiting for, and the corona has dampened its path. So if you look at India per capita steel consumption, it is much below the other countries. And that's the point that anyone hopes that, the steel consumption will go up, so the steel demand will also go up in India. And if you look at the steel import and export from FY15, sometimes we have been the importer of steel, sometimes we have been the exporter of steel. So by and large, it means that we have been insulated from what is happening around the world. And India has its own demand and its own consumption. We also know that India wants it to be the manufacturing hub, and our logistic cost is more than 14%, which is very high compared to other destinations. And that's why Indian government is also to reduce the infrastructural deficit. If you see the coking coal utilization in India, the Indian coking coal production has been stagnant, 15 to 17 million ton from last so many years. And it is the import which has been rising. And if India has to meet its steel demand of 2030, which is close to 300 million ton, then the coal import will be around 150 to 160 million ton. And that all I believe that will come from import. Because Indian coking coal has its own political issue also. Whenever there is a demand for coal, the Coal India prefers to produce thermal coal because the electricity generation takes the priority than the steel production. And thermal coal also, because the open cast mines, they had the lever of increasing the production at shortest time. Whereas the coking coal productions, many of them are from underground mines. And many of coking coal production are also having thermal coal blend. And whatever it is produced, we all know that many of it is taken to the thermal power plant because of the unavailability of the washing facilities. So India has its own challenges in meeting the demand from the internal sources. And if you look at the price forecast, as Alistair was mentioning, it is 109 and 10. And this was one of the forecasts in the lower case that it will be 103. So by and large, the demand in India will continue and it will continue to increase. And of course, today Australia takes a major share, but then Indian steel makers and others are also thinking how to diversify the risk from Australia to other places, because we have seen that one flood in Queensland, how it impacts the coking coal price. And that's why the journey has been towards, USA, Canada, and Russia. And if you look at the global coking seaborne exports, Australia's share is 59%, wherein if you compare with India, it is more than 17%. Similarly, with USA, Canada, and Russia, the percentage of share is more, whereas in India case, it is low. So mathematically also, it means that it has a great potential to import from other sources. However, the performance of coking coal in Indian steel blast furnaces has to be checked. So few steel makers have taken coal from Russia and they have tested it, and some of the results are very encouraging. Hopefully, it will see more import from Russia, and it also depends on the blend. In India, fortunately, most of the steel plants are in remote area, so the impact of COVID in plant production is not much. It is more on the demand sector. The places where the automakers are there, they are having more corona positive cases. So it's linked with the demand and it's linked with the supply chain where the migrant workers are not there. Hopefully the production will pick up in coming days when the government of India will change its stance from life to livelihood. And the next quarter we will see some movement, and probably after Q2, there will be a leapfrogging in the economy, which almost all the policy makers are believing. So the coking coal strategy will, if you take in terms of steel, I don't see any change in indigenous production, though the captive mines are going to start production. Commercial mining also has been floated by Ministry of Coal, but it will take its own time. Washery capacity also very limited, and we need to change the technology of Indian coking coal washery. Private sector entry, of course, may be a big game changer, but then there are hardly many coking coal which have a pure coking coal property. We have seen the coking coal blocks where 60% coking coal, 40% thermal coal, and how to use this thermal coal by the steel makers, that remains a challenge. And incidentally, most of the good coking coal blocks are still with CIL. So that has to be seen how that is taken from CIL and given back to the private players. We discussed about the diversifying risk of procuring from Australia, and that depends on how the coking coal from the different countries are behaving in the Indian steel blast furnaces. Some of them are giving positive results, and Indian steel makers are also thinking of investing overseas, but in the recent past, the result has not been so encouraging we have seen in Mozambique. So, nutshell, the import will rise. COVID is a temporary phenomena. It has impacted for this quarter. Maybe the second quarter start picking up depending on how the demand picks up, because Government of India is keen on pushing up infrastructure project. Maybe some incentives on automotive sector may come, because general public by and large India will not move in public transport. So how the private transport is encouraged, that will be the key. And the demand from the infrastructure which government is planning, that will propel. So we see a leapfrogging in quarter two, end of the quarter two, but quarter one we have seen it has impacted, and quarter two will be slowly recovering depending upon the push in the demand. Thank you very much.
Great, thank you so much for your slides, Pankaj, and thank you to all of our wonderful speakers for their presentations. I'd now like to invite our speakers to turn on their video and their microphone. Okay, so we already have some questions in. I'd like to remind you that you can ask your questions either by clicking raise hand or by using the Q&A to ask a question. We have 3 people who've raised their hands already, so we will prioritize those people first. Okay, our first person, Cameron Tuff. Cameron, I have unmuted you. You'll need to go on your computer and unmute yourself. Great, Cam. Cam, please feel free to ask your question. Okay, while we wait for Cam, I'm just going to take one of the ones that somebody sent us in advance. So before the webinar, someone sent me a question saying, how do you see the recent move from the Indian government advising coal-fired power plants to switch imported coal with domestic due to high domestic coal stock? Would you like me to repeat that question? So that's, how do you see the recent move from the Indian government advising coal-fired power plants to switch imported coal with domestic due to high domestic coal stock? Okay, so Mr. Arora?
Yeah, so as you see that coal India is, we are sitting at a stock of about 100 million tons. So that's a lot of coal. So the government is thinking that why should we import coal since all this coal is available, and Coal India as of today is being forced to reduce their production. They could have produced more because there's no offtake, so that's why they had to cut it down. So that's the logical reason. But I believe for those people, for the industry, for the power, and for the power plants for which the imported coal was more expensive, I think the logical solution is that Coal India, the imports will have to be stopped, and they will have to use domestic coal as long as it's available, and the cost is going to be much lesser. That's the reason. Yeah, thank you.
Great. Okay, thank you very much. So we're now going to take another question. So RP Ritolia, I believe you have raised your hand. So I'm now going to unmute you, and then you will need to unmute yourself on your computer. Great. Okay, please ask your question.
Can you hear me?
Yes.
Yes.
I can hear you. Thank you.
Yes. Okay, my question is to both Mr. Arora and Mr. Anurag. Both of them have indicated that the PLF for the power plant is going to be around 50%. The demand is going to be very low. A best estimate scenario shows the GDP growth this year to be 0.8 to 1.5%. So the necessary, the thermal coal requirement will be based on the power demand, which does not seem to grow up in this particular financial year. So how do you think that the Coal India, or there will be a production of 710 million or so? Number one. So far the substitution of imported coal is concerned. So you see right now the price of imported coal has gone down as low as 24 for the 4200 car Indonesian coal. So, and the quality issue is the another challenge. So unless and until that is economically viable for the plants which are using the imported coal, it will be just, I think, a wishful thinking that we substitute the imported coal by the indigenous coal unless and until the price is reduced, the freight is reduced. The comment from Mr. Arora and Mr. Anurag.
Sure.
Okay, so are you happy with that question, or do you need the question repeating? You're happy?
I'm okay. Yeah.
Great.
So, Mr. Ritolia, what is, you said that Coal India is going to be producing 710. In my presentation, I said 710 is the big figure. Perhaps in view of the market as it prevails today, they'll have to cut it down to around 650, and depending on how soon the effect of COVID is eliminated. So even if it is 650, it requires, and again, sitting on a demand of 100 million tons. So let that be used for reducing the imports. And in the normal course, I will expect that in the next 2 months or so, the country should slowly come back to normal production. So it will take its own time. So naturally, depending on how soon we are able to cross the hump of the COVID curve. So once we are able to do that, I think things will, because the country is hungry to come back to production, come back to normal life. And once that happens, things should come back to normal. Yes, definitely. But I agree that the imported coal definitely will not make a proper case for the inland plants. But for coastal plants where, like Chennai and all those places where some of them are very close to Indonesia. But the other day we heard that Indonesian plants, coal mines are also having a problem in respect of the COVID. So if that area is affected, then the production in that place is also going to go down. So indigenous coal will definitely be useful in such case. The import will definitely go down in such a situation. That's my thinking. Anurag, if you have something else to say.
I think I agree with most of it. I think the production from CIL is just a guidance. It's not something that anyone expects it to do this year for sure.
Yeah.
And they have already started working more on OB side, OB removal, as opposed to actually doing more production right now, because they have storage constraints and everywhere it's full. The inventory is all full. The second part of the question, I guess, is replacement. I think that's a long-term issue. It's not a short-term switching which happens overnight or maybe in a couple of months, or because there are financial implications of retrofitting a power plant, boiler specs, etc., and you have to also pass on that. There's a regulatory challenge to that, passing on those costs to how do you pass them downstream, who bears those costs, etc. So I think, and there has to be a contractual supply chain as well, because if you are still getting coal from auctions as opposed to fuel supply agreements, then that's again, no one would want to switch to that. So how do you ensure there is an FSA where CIL itself has a backlog of FSAs at the moment? How do you ensure supply, consistent supply? That's a challenge. So I don't think it's going to happen in the short term at all.
Great. Okay, we're now going to take the next question. So Jake Bowerman. So I've now unmuted you. So you should be able to ask your question now.
I have two questions actually. One was the question I wanted to ask before, but one's a follow-up from the first question. So I can ask them separately if that's easier.
That probably would be easier. Thank you.
Yep.
So what's your first question?
So the first one is, has interest been shown in the foreign direct investment since the coal reforms earlier this year? And generally, are international firms likely to be interested in the commercial block?
Okay, did everyone understand that question, or would anyone like it repeated? The question was, will there be interest, will there be financial interest since the coal reforms? Jake, is that a fair summary?
From international firms.
Well, should I? Why not? Yeah, why not? The financial, since, India is now becoming a very hot spot for people to come and invest. People, especially those who had invested in China and other places, are now trying to find an alternative place. So maybe India would be a good place for them to come in. And there is an interest shown to them. And I know that there are people who are moving around trying to investigate the blocks which are going to be advertised for auctions. So that's my feeling. Definitely, there will be an interest in that FDI. Yeah. Anurag? You have something to say?
Yeah, I think I would answer that question with a question. You tell me. I mean, on the ground, I don't know what's unfolding. If there is the challenge has been for India has been, as Pankaj sir also mentioned in this presentation, approvals, right? Land, environmental, forest, etc., etc. So as long as that process is smoothened, I don't see why not. I mean, if there is a consistent demand and the economy structurally, fundamentally remains strong and poised to grow, even if there is a short-term blip because of COVID or manufacturing or whatever, but fundamentally it's a low base economy which needs to grow. There is a requirement for jobs, a lot of it, all of it. So I think there is a market. If the regulatory structural processes are streamlined, I see no reason why not.
Yeah. See, our interactions on behalf of CII and another platform which I have used for interacting with the government seems to be very serious, and they know very sure the problem has been only the approvals, That is why you see the Ministry of Environment, Ministry of Forest, they have come out with some kind of a changed scenario whereby, you know, you have to apply online, and over a certain period of time, approvals are also being given. So this is something which has never happened before. So the government does recognize that if they have to succeed in this kind of mining, which is going to create a lot of jobs opportunities, so then they have to take care of the approvals in due time. You know? So that's what I feel so.
And Jake, did you say that you had a second question?
Yeah, it was. Thanks for those answers, by the way. So the second question was a follow-up from the advising the coastal power plants to switch from imports to domestic. How can this be enforced? Like, I presume if they ask them nicely, it's not going to happen. Like, what levers would they put extra taxes on, or would they restrict imports like they do in China?
No, we did not say that the coastal power plants are going to be converting into the domestic. We did not say that.
Wasn't the question asking for to reduce their reliance on import coal and then try taking more domestic?
But that is for the inland power plants, not for the coastal. The inland power plants, because where the cost of transportation inland is very high, so there the cost will be a different one. But for the coastal plants, and if they are able to get the imported coal at a lower price, why not? They shall continue.
Okay.
Yeah.
Okay. So my question still stands then. Like, what measures can they take to ensure that happens?
So I think if I can try and answer that, you have to look at the timelines. So this is not in terms of technicalities, you have to retrofit the boiler. You have to make sure the arrangements of coal injection change, and there's a lot of technical construction issues as well, depending upon how much space you have. But that is one part. The second part is financial. So who bears the burden of that retrofit, as I said earlier, and how do you get a secured supply? Because FSAs, the fight for coal in India is more or less a fight for contracts, in terms of getting coal, notified price contracts, fixed price contracts from the government of India. So I think that is the key challenge. Even if you switch, you cannot just switch on the basis of auction coal, because that is available sometimes, and that's a cost variation as well on top of it. So it's not a short term. As I said, you have to define the timelines. It cannot be done overnight, short term, 6 months, 1 year. It will take a considered opinion is required. A consensus needs to be evolved. It cannot be a guideline or diktat based kind of a guideline. You know, that's just not the way it works.
Yeah, and do they actually have any levers they can pull to say that those logistical issues are taken into account? Like, are there any levers able to be pulled to make these plants switch, or make them reduce their reliance on import coal versus domestic?
I don't think the government has a magic wand to do it.
It'll
take time. It'll take time. It's not something that can happen overnight.
Yeah.
It'll take time.
Okay, thanks.
Thanks very much, Jake. Okay, we've got so many questions coming in. So the next person, Glennie Sotano. I'm now going to unmute your microphone. So Glennie, if you want to try unmuting your microphone yourself, then you should be able to speak. Hi, Glennie.
Hi, Julia.
Hi.
Thanks, Julia. Hi, yes. Yeah, I have a few questions. Maybe I I'm from Indonesia, and maybe I attend these questions to both Mr. Aurora and Mr. Anurag. In the on the slides, I see that the inventory on the CIL, Coal India Limited, is still 75 million tons. And for Mr. Anurag, you said that indicated that Q2 second quarter is the worst period. And do you think the 75 million tons swelling inventory in your country is going to be disposed within this second quarter, or you think it will be prolonged until end of the year? Because I'm from Indonesia and we are the Indonesia producers, we need to know when will be the time for our volume to go there. As you know that yeah, Indonesia is playing a very important roles, and we export quite lots to your country. Thank you.
Okay, so
I still have more questions, Julia. Yes.
Oh, sorry. So just to repeat that question, it was saying that you mentioned that CIL had inventory of 75 million tons,
yes,
and you said that Q2 would be the worst. When do you think it will be disposed of? Will it be in Q2 or will it be prolonged?
Yes, correct. Exactly. Thanks, Julia.
Okay, so
take that,
Anurag?
Yeah, sure. Okay, so so if you look at these inventories, they're definitely high, but average inventories at the end of the year with CIL are around 62, 63 million tons, either ways, irrespective. So if you look at it from that lens, it's around 13 million ton excess inventories that they have at the moment. And for the second part of the question, I think when you look at that from a power demand perspective, I just suggest that you keep eyes. I mean, my guess is as good as yours in terms of demand recovery, right? So keep a track on the power sector growth, how the demand is recovering, and maybe you'll get your answer over there, because it will take, I mean, as I said, Q2 is a wash, and I'm talking about calendar Q2, not the financial year, because I think Pankaj sir, when he referred to Q1 and Q2 recovery, he mentioned the financial year in India, which runs from March to April, and we are in Q1 in financial year in India and Q2 in calendar year. So for Q2 is a wash, I mean the calendar year, and Q3 we should start seeing something up, and probably recovery kind of going forward over there. So as soon as it starts, depending upon how soon they push it in, I think they should return to normal inventories, which is around, as I said, 62 to 65 million ton. That's a normal level of inventories at CIL.
So are you saying that in the last quarter of this year, the we as the exporter of the coal, I mean, we have the chance to export in your country, or there's no chance at all?
No, so I can't speak. I don't have that much foresight in terms of crystal ball.
Right.
I can just say that Q2 looks to be wash, and the Q3 we expect and hope there is recovery, because it's developing into a major crisis in India as well. Lockdown and humanitarian crisis as opposed to economic crisis per se. So I think there are aspects to it that we cannot ignore.
Also, I would like to add that Coal India is going out of the way to make sure, to make it more attractive for the consumers to switch on to Indian coal, because of, certain things like, the financial, they allowed them to open the letter of credits, and they are going to give them certain concessions. The premium on the auctions have been cut down, totally brought down to zero. And I mean, it was not an official news, but I had an inkling that perhaps the price of coal, the difference between the power and the non-power coal could be reduced, We don't know. There could be a possibility. So if all that is, basically they are trying to encourage the users to go more for indigenous coal rather than the imported coal.
All right. Mr. Aurora, I have one last question.
Before we move on, Pankaj, is there anything that you would like to add to that?
Yeah, I'm saying that it's somehow people having a pessimistic view, but I'll add 2 points here. One point is that Government of India is trying to come with second stimulus package. It was supposed to come on Monday, but so far not. But I'm sure that it will come in coming days. And as government has indicated that they are shifting their focus from life to livelihood, and that will mean that they will focus more on economy. So as Anurag also mentioned, the next quarter will be like, going little better than the previous quarter, but I'm very much sure that Q3 will be leapfrogging, and that's why internally they're making many policy changes. So that is one. And second, time like this also brings some opportunities. Like steel makers, they are now trying to increase the blend of Indian coal in their steel making. So this will also bring some opportunities for others also.
Great, thank you very much. And Glennie, did you have a second question that you wanted to ask?
Yeah, I think I still have the last questions. And this is for Mr. Aurora.
Yes.
Yeah, Mr. Aurora, I have a question.
Yes. Yep. Go ahead, please.
Okay. I've seen on the slides, it's a very interesting thing that on the 2020 to 2021, India is still having some room for us, 90 million tons of thermal imported coal. But the thing is, I think every country now is focusing on their own problem on how to solve this COVID. So it's going to be interesting to relate this with the liquidity issue. How do you see, I mean, in your government policy on this one? Because we don't have a particular case, but I think some Indonesia producers are still delivering coal to India, but very unfortunately during this pandemic, we are not able to bank our documents. So in the banks, I mean, so well, I just want to know your view about this in connection with the next year, or maybe this Q3 for this our chance to export our coal in connection with the liquidity in the country, in your own country. Thank you.
Okay, so I believe your question was, how do you think that liquidity in India will impact imports, in particular imports from Indonesia? Is that, is that an okay summary?
Yes, Julia, thanks for the summary.
Great. Everyone, are you happy with what I said? So how will liquidity in India impact imports, particularly Indonesian imports?
Well, I think the imports are going to be affected not by liquidity, but for other reasons, you know. As I said, that people when they have to, you know, buy, so whether they buy Indian coal or the imported coal, the liquidity has to be there. So there will be some sort of a, you know, the letter of credit is the same everywhere. So if that is being given by Coal India, similarly it's given by the Indonesian. So liquidity is not going to be a factor whether we decide whether we use imported coal or Indian coal. So I think it's going to be more a question of cost and availability. That's what is going to be more important. Thank you.
Great. Does anyone want to add anything to that, or are you happy to go to the next speaker? Okay, we're going to take a question from Saket Goenka. So I'm now going to unmute your microphone. You will then need to go on your computer and unmute yourself. Okay, while we wait for you to do that, we're going to take a question that has come in. Oh, Saket, are you ready?
Yes, sir.
Perfect, thank you. Please ask your question.
Yeah, so as we see that RB2 quality of coal is cheaper now and is being used more into the steel industry and sponge iron industry. So do you see RB2 as a substitute for Indonesian coal in the future? And do you see the Indonesian coal prices for 4,200 NAR coming to nearly to $20 or below that?
Okay, so just to repeat your question was, do you see sponge iron as a substitute for?
No, not sponge iron.
Sorry.
It's just RB2 quality of the coal. That is South African RB2 quality, because the prices of RB2 coal has gone down specifically in the international and Indian market. So do you see it as a substitute for Indonesian coal? And the prices of Indonesian coal of 4,002 NAR, can we see the prices below $20 or $20?
Okay, so to repeat that, do you see South African RB2 coal as a substitute, or is it a substitute for Indonesian 4,200 GAR coal at $20? Is that right?
Yes, yes.
Perfect. Okay. So I will offer that to the speakers to see if any of them feel they have a strong answer.
Not me.
No problem. I mean, if you don't, if none of you have a, a clear answer in mind, then that's no problem. So Saket, maybe I will offer that up to the floor. If anyone in the audience would like to answer that question, then please use the Q&A function to write into us. Saket, did you have any other questions that you wanted to ask?
Yeah, one more question. We are seeing that all the coal industry has a bloated inventory, like Coal India and everyone, and so we see that the steel production is also going through a very low demand. So, and in the future, we can see that the countries will depreciate their currencies to, we can say, benefit the exports, and they will also give export benefits to each of the manufacturers. So how do you see the steel prices in the future and the economy as a whole with these COVID lockdown and all the impact on the manufacturing? Because the manufacturing cost, the manufacturers of steel will unable to, you can say, recover their fixed cost. They would look to recover their variable cost, but the export would be very competitive because all the countries would like to export more of their steel productions and everything. So how would you see our Indian industry, steel industry, cope up with that?
Okay, so how will the steel industry cope with all the changes that have emerged from COVID-19? How will it impact the steel price? So, Alistair, Pankaj, Anurag.
So I'd like to answer the first question which he asked about the South African coal. So most of the sponge iron producers which use the coal, they predominantly use South African coal. I have seen in Tata Sponge also, which has now been Tata Steel Long Products. They preferred South African coals. But majority of the secondary producers, the sponge iron plants are not in operation. So it again depends on how it evolves and the market prices remain at that point of time. And can you repeat the second question once again, please?
Yeah, see, actually, sir, I wanted to know whether, all the economies would want their export to be on a higher side. So to promote the exports, they would depreciate their currencies and give their manufacturers export benefits. So how would you see India as a steel exporter, and how do you see the Indian firms how they will compete with other countries in the export of steel? So how do you see that?
So if you see the recent data, the export of semi-finished steel to China has gone up in recent past. The logic is still yet to be known because probably they say that from India it becomes cheaper. In policy making, there are two things which are mooted by the government of India some time back. One was the remission of duties and taxes on exports. So what they are doing, they are trying to understand the taxes and duty which Indian steel makers have to incur when they export. So generally the figure was 6 to 7%. So that was the incentives which will come back to steel makers, because that seems to be WTO compliant and not as the other measures which were being taken care. That was the first thing which government of India was trying to do. However, it has been given a go slow as of now, but that will come for the long run. Second was the border adjustment tax to prevent the import of steel in India. So these were the two broader policy frameworks, but when the internal demand is down in India, I have seen many of the steel makers, they've started exporting. Earlier, the sale used to export to Nepal and Bangladesh. But if you see the data of China's import, there has been import from India to China, and steel companies are doing that. And for time being, just to meet the cash flow, because there are certain fixed costs for the steel makers, which they wanted to have by exporting. Maybe it may not be so lucrative as of now, but then at least it is giving the revenue. And as I mentioned that today, Govind Mandi also has been given go ahead to start. So secondary producers, when they start producing, the primary producers also will take lead. And this is a matter of quarter. And fortunately, most of the steel plants are in remote area where the corona cases are not there. Only the 2 points which we have to handle, one is the secondary steel producers and the migrant workers who will be helpful in unloading and loading of material.
Okay, thank you.
Saket, this is Alistair. I mean, I'm not sure if you see the fast markets news, but we reported yesterday, along with Mr. Pankaj's point, that JSPL in particular had seen a doubling of exports in April on a year-on-year basis. And what we find from a pricing perspective is that Indian exporters are as, if not more competitive than pretty much anyone else out there these days. So rather than material coming into India, it's more the case that India is on the front foot with regards the export market. It's not their core strategy. Indian steelmakers, please correct me if I'm wrong, Mr. Pankaj, but far prefer to sell domestically with inside India. That's what their strategies are about, not the export markets. But in the short term, they are perhaps better positioned, judging by the latest data, than anyone else at reducing a domestic surplus by increasing those exports. The other thing about the prices that we track is that they are effectively leading indicators because they are booking prices for forward delivery. So whereas the fundamentals are likely to be much more obviously slack and negative in the quarter to come, the data that we haven't seen thus far, the prices already reflect that. So in the same basis, we're likely to see prices start to improve as the fundamentals are actually getting worse, because the prices today are realized tomorrow, and what happens tomorrow will be about a future development which, as Anurag was saying, is likely to be better in the second half of the year, and that's how we see it for steel as well.
Great. I'm now going to take another question. So Adji, I'm now going to unmute your microphone. So you will need to unmute yourself. Hi. Please go ahead and ask your question.
We know that currently India is taking steps to increase and attempt to reduce the country. The question is, I have 2 questions. How do you think of the opportunity of Indonesian coal supplier until end of December 2020 to Indian market amid the corona pandemic? We all know that India is taking steps to ramp up domestic consumptions. This is the first question. The second question is, in your personal view, when do you think that Indian government will be reopening up from locking down, especially in the coal business? As you know, coal is a major commodity to support energy needs in India.
Great. Okay, so I'll just repeat that because I think the audio broke out a bit in the middle. I can see that you've also typed the question on the Q&A, so I'll just read it straight off of that. So question 1, how do you think the Indonesian coal suppliers, or how do you think, hold on 2 seconds, how do you think
of Indonesian coal supply?
How will it affect Indonesian coal supply to India? How will the pandemic affect supply? Is that correct?
Yes, until end of December. Yeah, until end of December 2020.
So how will the coronavirus affect Indonesian imports?
Correct.
Okay, so I'll open that up to the speakers.
Okay, as I said that when, the coastal plants will continue to import as of now, whereas the inland plants are probably going to depend more on the indigenous coal. So if the Indonesian suppliers have contracts with the plants based on the coast, you see, then in that case, perhaps their exports will continue. But for the other ones, I think it's all a matter of cost. And probably if the inland costs are going to be cheaper for the indigenous coal, they'll try to switch over. So that's something which will be decided on the location of the plant where you're supplying.
Okay, great. Does anyone want to add anything, or should I go on to the next part of the question? Okay, so the second question was, when do you think that India will be opening up again from lockdown, especially for coal business, which is the main commodity for the energy industry? So when will India be opening up again?
Well, India has not really closed anything because the coal mining and the people connected with coal, they are in the essential services. They are working like before. So they have not really closed anything. What is closed is the industries in the hinterland of the country. So whosoever is using coal, whether it is being used for power, then the requirement has gone down. And if you are a steel plant, you have the steel was not selling. So people had stopped their production for some time. Similarly, the cement plants, they are not selling because the construction activity is not happening. So we are now in a situation whereby things are going to gradually come back. They have just opened out 2 days ago for the industrial and the construction activity to open up. So once that I think it'll take about 2 months or so, and they'll also have to closely monitor what is the impact on the number of cases. If it has a very strong adverse impact, then they will have to slow down. So we'll have to wait and watch, because this is a transition which is going to be taking, and we are taking a trial. And I think we'll take some more time to really determine how is going to be our response to all this. If hopefully we are hoping that, things should succeed and we should slowly come back into circulation once again. Yeah.
Great. Okay, and with that, I would like to say thank you to all of our speakers for their presentations and for all of the hard work they put in. Thank you to all of our audience, and I'm so sorry to anyone who is waiting in the queue with their hand raised or who's asked a question that we haven't been able to answer. We will do our best to try and follow up with answers. Next slide, please. I'd also like to thank our sponsors, EcoCarbon and Crew Overseas Coal Trading Company. Thank you very much for sponsoring today's session. At the end of this webinar, you will get a pop-up which will allow you to give us some feedback about the webinars. Please do take a minute to feedback to us. We do read all of the feedback forms and improve the webinars accordingly. This week, we will be sending out a survey asking you for some feedback about digital events, which we are planning to run in the autumn. So please do make sure to let us know about your ideas on our digital events. Next slide, please. Finally, I'd just like to remind you that the Coaltrans Connect Webinar Series will be going ahead over the next few months. The next 3 sessions will be covering the European coal market, the Indonesian coal market, and a gas outlook for the coal industry. Please keep an eye on the Coaltrans Connect website for the dates and speakers for those webinars. Thank you so much to all of you, and I look forward to seeing you in a webinar soon. Thank you very much, everyone, and goodbye.
Thank you, Julia. You've done a great job.
Thank you.